The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
Good afternoon, good Friday afternoon. This is The Call. 10 companies picked by you, 2 expert guests, 1 hour. Friday, the 23rd of June. It's great to be here with you, and also good to be here in studio with Luke Winchester from Merewether Capital, who's joining us, and Claude Walker from A Rich Life, who is joining us via remote. Okay, guys, so this is another week in which we've seen big, wild swings, although it looks as if we could end the 5 trading sessions in positive territory. Claude, have you been making any big moves with your portfolio this week?
G'day, Nadine. No, I haven't been making any big moves. I have just taken a quick look here, just been very, very slightly nibbling at, I guess, some of those higher quality growth companies. You know, of course, I'm quite into investing in software companies and stuff like that. A lot of them have been hit down a fair way. So I've just been doing some tiny nibbling over the last couple of weeks, really. And that sort of that remains the case, really. Like, just because it's actually really nice today to see a bump on all of those names, but yeah, I wouldn't say the pain is necessarily over. There tends to be like rallies during a bear market, and I suspect this is one of them. Yeah,
what do you think? We found a bottom, or it's too early to call it?
It's too early to call it for sure. It's a very interesting market. I mean, you know, commodities have rolled off pretty hard, yields as well, and so that's the market, I think, signalling a recession. You look at where valuations have come down to. I think valuations on markets are signalling that as well. So we haven't seen that come through in the earnings yet. Most updates have been okay. There's been, you know, some specific factors around supply chains, and I think retailers and discretionary are struggling for some obvious reasons. But, you know, broad-based, we haven't seen it come through in the earnings yet, but the market's predicting that will come. Like Claude, I haven't been, you know, I wish I had more cash going into this. So, you know, with what I've got nibbling away, I think these broad-based sell-offs also give you the opportunity to rebalance portfolios. You know, when everything's been sold off, you can sort of, you know, exit the lesser conviction stuff and top up your higher conviction stuff, because everything's sort of been sold off to the same degree. So, yeah, too early to call it bottom, but, you know, it has been a good week, and I think there's some signals that, you know, that intense volatility may be slowing down anyway.
Well, look, I think nibbling has, you know, officially entered the vernacular, and I think it started here. You heard it here first, as they say. The companies we'll be discussing that you've nominated: Swoop, Xero, Aerometrics, Carbon Revolution, and ProMedicus. We've got the team for that one. But to start with, the stock of the day, we're really leaning into the small caps theme this Friday, is Diverger as the stock of the day. So the financial services provider is eyeing off Centrepoint Alliance to increase its market share. So it's put a bid of more than $30 million on the table, plus Diverger stock on offer. So what do our experts make of the deal? And I guess in general, sort of the potential for more M&A activity in that area of the small cap universe. Claude, can I start with you, Diverger?
Sure, yeah. So I should disclose I own shares in Diverger, and I'm surprised to see it being acquired. I thought the shares of Diverger are really cheap. They trade on a dividend yield of around 4 to 5%, or maybe 4.5%, I think, at the moment. And you know, a PE ratio of probably like 10 to 15 if you're looking at the FY 2022, or at least my best guess at it. And so it's sort of like own that as like a bit of a value stock. Got some, you know, reasonable businesses in there. It's a combination of, I guess, financial advice style businesses, but also more importantly, just providing that back end to financial advisors. So and also accountants. So we're talking about you know, basically the training and the worksheets and the all the kind of materials that they might need to use to maintain their professional standing, and also to do their run their day-to-day business, practice notes and the like. So I like that aspect of it, and so I guess this potential takeover makes sense. Now it's not a done deal. I think they've got a right to 19% of CAF, but you know, that doesn't mean the whole deal's going to get done. And basically, it would make at least some sense from the point of view of if they add a whole bunch of financial advisors and stuff, then presumably they can start using their back end services to supply them and support them. So that would be a positive. There's some vertical integration advantages there. On the other hand, as a shareholder, I'm a little more sanguine at the thought of issuing a whole bunch of shares to pay for an acquisition when I already consider the shares to be cheap. Generally not the kind of play I would like to see is issuing cheap shares. I'd probably actually prefer a company be buying back cheap shares. So yeah, not feeling super excited about that aspect of it, and definitely concerned if they try and they take a swing and a miss and there's a whole bunch of distraction and it doesn't come through. But also if it does come through, you're going to have a significantly bigger company. There's going to be some vertical integration. And one of the reasons that I think Diverger is cheap is because it's so small, so under the radar, so liquid, nobody cares about it or looks at it. So just it getting bigger could actually have a benefit, especially, if and when we get through this tough cycle. A lot of financial advisors have left the market. These guys will be one of the bigger players remaining there, that could put them in a strong position for good earnings growth. And then there'll be a bigger company. They'll probably catch the eye of more investors. So once we get into a bull market, I could definitely see it re-rating. So not a terrible idea, definitely waiting and watching, but no clear verdict from me about whether this is a good thing or a bad thing yet. Well,
good, bad. Luke, I'll ask you the same question, but could it also be complicated by some other company coming in with a counteroffer for Centrepoint?
For sure. It's a very complicated, a lot of complicating factors to this, and I've had a very interesting looking over it today. So, I used to work for an advisory business, and I can see the appeal that Diverger, Centrepoint, these businesses have, because you have advisors who just want to help their clients, but they just get beaten down with red tape and compliance. And so you come in, you take all that back office compliance stuff off them, and then it becomes a game of scale, because that's not fixed costs, but you can definitely get leverage over that. And so a tie-up like this to take what would be maybe the third and fourth biggest players in the market, you get some real scale behind it. I can definitely see the appeal of making an offer like this. But to dig into a few things that Claude mentioned, this is a smaller business trying to take over a larger one. You don't see that very often. It's normally the other way around. And it's also the business trading on a lower valuation using script to take over a business on a higher valuation, which Claude was alluding to. So I actually wonder whether this is in the best interest of everybody, and if the idea is to have these two businesses come together, is it better off using the Centrepoint Alliance script, but being more higher valued? You would have less of it. You also have Hub owns a big chunk of Diverger, and Clearview Wealth owns a big chunk of Centrepoint Alliance. I don't really know what their views would be on this. They're obviously there for some strategic alliance to be close to an advisor network. Would they support any sort of takeover? I guess so, but hard to know. And then my big one, as Claude sort of alluded to, I think this is one where I could see maybe egos coming into it. If this doesn't go through at first, it could really drag on, mostly because of the way it's been structured, going through Thorny with a call option. It's a very aggressive method to try and get, not control of the business, but a stake where Centrepoint has to listen to you closely. So I agree with Claude, just watch it. I think if this happens smoothly, I would really take a close look at this business, because you're getting some real scale into a business that needs scale. But as it stands today, I would just watch how this all plays out, because there's a lot of moving parts to it, for sure.
So stand back and watch this one happen. So Claude, are you holding on to Diverger though?
Yeah, definitely not taking any action right now. Like, as it stands, I still think the stock is cheap, but that I don't think this will blow up the business, but I definitely think that there's more risk in it trying to pull off something of this scale, for sure.
Yeah, you sound a bit flat over this one, to say the least, Claude. All right. Let's get to the companies that have been nominated by our viewers. The first one is coming from David, and it is for Swoop. SWP is the ticker code. I'll start with you, Luke.
So this listed a couple of years ago, and I think the market loves pattern recognition. So we had Unity Wireless come to the market. It was like all the guys that were like Xfocus, Amcom, M2, jump into Unity and just redo that playbook of acquiring and building out an asset. And then Swoop comes along. It's a very similar thing. You've got James Spenceley there. The managing director is ex-Superloop. So you're bringing these resumes together. They know the industry. They know how to roll it up. It just hasn't been the right market for them, obviously. Market sold off quite heavily. Stock's been hit pretty hard. Looking at it today, 100 mil market cap. It's pretty well capitalised. 40 mil cash in the bank. Plenty of debt to continue that roll-up strategy. They're probably getting some assets for cheaper than what they were potentially looking at a few months ago, which is nice. It's not as good as Unity Wireless though. These guys are doing fixed wireless towers and dark fiber networks. They're decent infrastructure assets, but a large part of the revenue and the earnings come from your lower margin, more competitive, just consumer-facing business of running a telco. So that's not the sort of business I think the market loves. I mean, Unity, the reason why Unity was priced so highly and chased by private equity and superannuation funds, it's that pure infrastructure play that those guys love. Whereas these guys give you some of it, but there's still that the other side of the business. Look, I actually, it's come off such a long way. It was one I sort of thought to myself, I'm going to go back and have another look at this after taking a brief look this morning. So I would say a hold because if you're there, I didn't see anything that you would panic other than the share price. Any of the technical guys coming on would probably say sell straight away looking at that. But from a fundamental point of view, I didn't see anything that would warrant to panic with this business. They're guiding for 12 mil EBITDA now. There's some heavy investment there, so from a free cash point of view, it's probably still negative. But as I said, plenty of cash in the bank, plenty of debt facilities. I'm not worried about liquidity by any means. So yeah, I came away and thought to myself, I'll take another look at this business. It's come off a very long way in the last few months, and I think it looks quite interesting.
Is it interesting to you, Claude?
I wouldn't say it's that interesting. No, I actually agree with most of what Luke said. I think I'm a little bit too old for micro telco roll-up stories. The point about pattern recognition is really good. But I think that the overall pattern of telco roll-up stories on the ASX, if you zoom out long enough, is mostly it ends in tears. Maybe not tears, but usually there's a bit of a cycle to these things. So although you can definitely make money from them if you buy them at the right price when it's cheap, especially if you buy at a time when they're sort of around a profitability or free cash flow inflection point, that can be really good. But I don't think Swoop's really there, not in terms of actual profitability and free cash flow. No, certainly not, because they're still investing quite heavily, or at least they were in the last quarter. So yeah, probably a bit early from that perspective. And then if I were to buy Swoop, it would be more just for a bit of a momentum trade, or at least, I'd go into it being I probably want to sell this in 1 or 2 years. These things don't tend to usually be I don't know of any that's your long-term buy and hold. And for every one that sort of works out okay, you've also got probably 2 that just were stacking melting ice cubes. I've used that metaphor before, and end up going nowhere and just sort of build a business but never make that much money for shareholders.
Just an avoid, let's call it that. That's Swoop for you, David. Nancy's question is next. It's Xero. She's been dipping in and out and wondering if now is a good point to start buying in. Xero is one of those companies that has been hammered in this sell-off that we've been experiencing since the beginning of the year here, particularly in tech. Now, today it's trading at $80.38 to the very moment. So good day today for Xero, up by about 5%. Claude, at what level, if any, are you comfortable buying Xero?
I guess if I can get to that exact answer in a minute, I basically, I own Xero shares, and I have done since I bought them at, I think, around $64 in the pandemic sell-off. And then, of course, I didn't buy very many, and it went up really crazy prices. And I just basically held on to a small holding because it's such a high-quality company. And what I then did is I've been waiting for so long for it to be come down to a more attractive price. When it started coming down to around $80 before the results, or actually even below $100 before the results, I did start buying just a small amount of shares. Then what we saw more recently is that the company actually put out its results. Now, they were all right. It was actually great to see that the annualized monthly recurring revenue was up 28% year on year. So that's pretty good organic growth. Historically paying around these prices for Xero based on a multiple to annualized monthly recurring revenue, you would have done okay. So it's sort of below the average there. But, or actually I think, if you bought at $80 based on the average multiples, you'd do okay. And so I had bought some at $80, but then also what I found disappointing in the most recent results is they had some write-downs, and I didn't feel like that there was really an adequate mea culpa or post-mortem or any kind of reflection on, why they're making acquisitions that then result in write-downs. So that just made me wonder, is there some hubris going on here where they could just make really big acquisitions with their cash, and then there's just no accountability if if those acquisitions don't do very well. And then the second thing you've got to remember is that if there is a recession, which I now think is more likely than not to be a recession, obviously it's not guaranteed, then I think that, that does at least set Xero back, because even though they're it's such a great high quality business, because the Xero account is like the last thing you'd cut as a small business, basically. But if you have a recession and smaller businesses go out of business, then they will lose subscribers. And then, the final thought there is, like, I just find it slightly annoying that, like, when they clearly could run this business at a small profit, they instead choose to run it at a small loss. I just feel like, oh, come on, guys, just make a tiny profit to prove you can. That's probably more just my bugbear. There's no real criticism of them for continue to invest heavily in growth. That's what they should do. But yeah, just a few little things that made me a little bit less bullish Xero, and thinking that just even the optics of it, now that it's like lost money in the last financial year, I feel like the share price could go lower. So as a result, I've not been buying shares at any more since the results. At least not at $80, and I'm looking for a lower price, probably like with a 6 in front of it at the least.
Okay, got it. Thank you. What do you think, Luke?
Yeah, I noted the same thing. It's about 10 times recurring revenue, which historically is okay value for Xero, but in the grand scheme of things, that's still pretty steep, and especially compare it to some American peers that have really been hit hard. I agree with Claude. The latest result wasn't fantastic. The revenue growth was good, but some higher costs, and they actually did have a small profit in FY21, Claude, and I think that's where your frustration probably comes from, is you would like to probably see that continue rather than swing back to a loss. It's too big for me. I'm a micro cap investor, but I always have it as an example of one of my higher quality businesses on the ASX. And the reason why is, I'm not sure whether Claude uses Xero for a rich life, but I use it with Merewether Capital. I got my email the other day saying prices are going up, and I did nothing about it.
Yeah.
Not once did it cross my mind to look for another provider or anything like that. So, they'll have just an organic revenue growth this year from a pricing increase, which is, that's the hallmark of a quality business. Ultimately, I think something like this just comes down to your investing time frame. We've had a few businesses come up when I've been on the call lately, like Breville was one the other day. What else was there? I think Domino's Pizza was another. Where if you're willing to take longer term views, I think these are levels where you can start to enter into them and build a position for that longer term. But that valuation is still steep. I don't think you're getting it at a really cheap valuation today. It's one they need to grow into over time, which is where that long-term philosophy needs to come from. Look, it's a hold. I think it's a pretty classic hold. It's too high quality for me to say sell to someone. But I sort of agree with Claude. You either want it a bit cheaper today if you're there for a shorter-term outlook. If you are a genuine long-term investor, I think it's one you could start to build a position in, but be prepared for it to be volatile just in this market.
Got it. Thank you. So this is Aerometrics next on the list, AMX for Raj. He's calling it an unloved microcap. He doesn't think the company will pass some filters at all, so he really wanted a small cap view on the company, which did present recently. So he thinks that the offering is pretty similar to Nearmap. So is it a buy, or is there something that he's missed? He's also pointing out that they've got cash in the bank. Luke?
So I own this business with Merewether Capital. It was sort of a medium-sized position, but we'll put the chart up in a second. We'll see it's turned itself into a smaller one for me. Their Australian business does compete with Nearmap, almost an exact peer in that subscription aerial imagery space. And look, it's doing okay, but I've always been apprehensive of the fact that Nearmap is that big 800-pound gorilla in the room, and they can flex their muscles if they feel the need to. And there's probably been signs they have been, actually, from a pricing point of view. Where I've sort of always had a good outlook for this business, though, is they do some 3D imagery, and they've been doing that for quite a while and developed a product that has a genuine edge over its peers in the way they capture and process. And with the quality of that data improving and the engines used to view that data also improving, it just means more use cases are popping up where 3D data is replacing 2D data, and the quality of it means more analytical tools and software can be overlaid. And without fail, almost every business that's doing that is using Aerometrics data, which to me sort of signifies that they do have that leading product. Now, their results their forecast results the other day were okay. Raj, who asked the question, one thing you do need to note though is their preferred reporting metric is EBITDA, which I really don't like for this business because they amortise their capture costs when they send the planes in the air. Which basically means by using EBITDA and emitting amortization, you're effectively removing that cost, and that's a genuine cost to this business. They need to keep planes in the air and keep capturing to have a business that operates into the future. So look at free cash flow, which is still negative. I'm there, even though I recognise that fact because they've got plenty of cash in the bank. I think they can, I don't see them needing to raise capital anytime soon, so they can continue their growth plans with what they have. And I think the opportunity they've got with the 3D stuff is where I'm interested in this business. Last comment off the cuff, it's about 22 mil market cap today. That's actually pretty much liquidation value for the business, about 12 mil cash in the bank, and I think they've got $11 million in planes on the balance sheet. So, you could liquidate the business tomorrow and get a return. So sort of says that the market's, not entirely rational with the operating business, but the management need to execute, no doubt about that.
Okay, so you've been in it.
I'm just holding it. So for the purpose of the program, I haven't bought any more. To me, it looks really interesting. It's more my position sizing that I'm holding.
But I mean, that was a pretty terrible chart. So would you wait if you're a viewer, if you're Raj, to see a turnaround?
I'm not a chartist, so for me, I wouldn't wait for the chart.
I'd wait for the
business. Yeah, that's right. I'd wait for the business. Now they're in a trading halt today, actually. So. Pending, the sale of some of their data sets. So look, wait and see what that announcement is. I've obviously got my fingers crossed as a holder that it's some good news. But yes, I've been there early, and that's my style as a micro cap investor. I understand the risks I take. Claude, I think, is a little bit the same with some of his holdings. If you're not someone who wants that risk, of course, sit back and wait for the businesses to execute, wait to pivot into profitability.
What do you think, Claude? See it any different?
I do see it a little bit more negatively than Luke. I mean, first of all, I think my more negative criticisms of Aerometrics would have held a lot more weight when it was trading at $1. So it's just come a long way down. And the bit of what Luke said that I really do agree with, which is that basically that it's actually quite close to a conservative valuation of the business now. Now, previously, this business had been profitable. I guess its business model was getting outdated because, and this is the key point that I want to make, is that the questioner, compares it to Nearmap, which is not unreasonable to do. But I think you've got to remember, and look, I'm not a massive fan of Nearmap either, but I think you've got to remember that Nearmap is a much more subscription-based business that has a lot more scale and maturity. So if you're talking about, this Metromap product, which is the main growth engine, which is also, their reason for listing was because they wanted to invest in this subscription product and be able to start competing more effectively with Nearmap in Australia. And I think they've been talking about going to America as well. Well, I mean, first of all, I think investing in America is a wrong idea. I don't like how global this business is when it's so not dominant in Australia. And basically, the whole point is that, a year ago, basically, they were saying that they were hoping to get to break even pretty soon with Metromaps. Well, I'm not really seeing that happen anytime. I don't think that that's going to happen, and I don't think that has happened. Certainly, with their 2.2 to 2.5 normalized EBITDA at a free cash flow level, they're not break even. And so I would just sort of make the point that actually a lot of this business, the LiDAR, certainly the aerial photography, and I think the 3D mapping, Luke, you may wish to correct me on that, they're all sort of more project-based. And indeed, the trading halt today, they're talking about selling a data set. That sounds more like it's probably like a one-off style sale thing as well. So I think that their business is a lot less recurring revenue than Nearmap. And I think one of the reasons that you do see Nearmap trade at such a premium to Aerometrics is because it's a far more subscription-based business. And it's got a much bigger collection of aerial images that they sell by subscription like that over a much broader client base in both Australia and the US. And there's just a bigger company, so small cap funds are in it, and there's room to get in and out there. So I wouldn't compare it too closely to Nearmap. I feel like it wants to be more like Nearmap. Sounds like the bit that Luke's more excited about isn't so much like the bit that they've sort of advertised a little bit, which is the Metromap thing. Okay. So yeah, personally, I'm not super excited about it, but I also agree with. I'm not going to avoid it. I'm going to call it a hold at these levels. At higher levels, I would call it an avoid. But given that I actually do think it's come down a long way, this is a real business. Like, we're not in some crazy story stock stuff. This is a real business, existed for many years. It's looked after itself before, it can do so again. Definitely not that bad, but I'm just not super excited about it, so I'd probably call it a hold.
Got it. Thank you. Now on to the next one, Carbon Revolution. Now this, again, is a chart that's looking pretty terrible. CBR is the ticker code for Carter. So is there value in this company? Share price is down 73% year to date. Claude.
Yeah, so this is one that I am less excited about. Let me see if I've got it in front of me. So I do. Yeah, so in the last 9 months, they have receipts from customers of 29. So this is like selling their wheel resins and stuff like that for lightweight wheels, you know. And the exciting story that they've told people is, you know, I guess to make cars faster, they can have lighter wheels. So, you know, I guess people want faster cars, and also electric cars can benefit from less load there. So that's the exciting side of the story. Look, the financials are not so exciting. Receipts from customers in the last 9 months of 29.2 million. You know, even after getting 3.8 million in government grants, they still had net cash used in operating activities of 21.5 million. So just the product manufacturing and operating costs that were associated in that 9 months was 25.4 million. The receipts were 29.2 million. This is even if you just take out the manufacturing costs, it's a very small amount of money that's coming into the company after manufacturing costs. That's before you get into admin costs of 3 million, 15.5 million on staff costs. So just the economics of it look, you know, to my mind, they look quite bad. I would not be excited by that at all. And on top of that, you know, I was listening to the most recent quarterly presentation that they did, and the CEO said that COVID-19 related absenteeism is still commanding our attention. Now, absenteeism means the practice of regularly staying away from work or school without good reason. So I don't know what's going on there, but that prompted me to look at the Glassdoor reviews. And you've got to look past the actual 5-star reviews here. You know, even a 5-star review on Glassdoor that has the title great from an anonymous employee on 26th of February 2022 this year, it has as cons no potential growth in the company. Now, I'm guessing they're talking about their career growth, but that's the 5-star review. Like, let's not even get onto the 1-star review, which I guess is kind of what I thought might exist when I heard him talk about absenteeism there. And that was a bit of a red flag to me. So yeah, strong avoid for this one. Even though it's come down a long way, I wouldn't be interested in it.
Got it. Thank you. It's an avoid. Luke, would you be buying CBR even though it's looking pretty cheap?
No, it's an avoid for me too. And one thing I was going to say with this one, if anyone's keen on, you know, building up their analytical skills, a good task to do is, before you dive into the financials of a business, stop and think, what do I expect to see? And so this business does really niche, you know, rims, tyre rims for cars, as Claude pointed out. And their customers are like Ferrari, Porsche, really, and the high-end models for these guys too. So when I step back and think to myself, what should I expect the financials of this business to look like? I'd expect really high-end niche manufacturing to be very high gross margin. But then, because you're in a niche, you know, not a large addressable market, so you just extract, you know, basically the high margin from the small niche you're in. And it's the exact opposite, as Claude points out. It's very, very low margin, and they're trying to obviously compensate that low margin with scale and to drive revenue through it. But I just wondered, like, whether the market for this product is big enough that scale can ever come through in a meaningful way. It's come on before, and I've made the comment that I think management have just mispriced this product in the market. I think rather than trying to be more of a mass scale solution, I think they should double down on that niche where they're in, but really drive the high value, high margin with it. I think they're in a bit of trouble, to be honest. 34 mil cash in the bank, as Claude points out. They've burned through about 50 in the first 9 months. I'm not sure whether they can find funding from anywhere else, but any sort of equity funding on the market with that chart, it's going to be pretty ugly. So it's one I would definitely avoid until, you know, a couple of questions are probably answered.
Yeah, thank you for that. And now we get to Jason's question on ProMedicus PME. No context here, Claude. So I suppose the most reasonable place to start is buy, hold, sell today, given the price.
Yeah, so for me, it's still a hold. Obviously, it's actually still one of my larger holdings. Like back in the day when this was a $15 stock, it was a massive holding. It was like a 40% holding for me. But the reason I love it is because of the quality of the business. One of the best quality businesses on the ASX, if not, I would argue, the best. However, that doesn't mean it's a buy at any price, of course. And in fact, not that long ago, I was talking about how I was selling it over $60. Now, the reason that it's such a good quality business, which I still think it's worth mentioning basically, is that look, this is just like basically for many years been proving itself as being the best product that allows radiologists to be the most efficient they can be, and also diagnose illnesses more efficiently. So it's not just about seeing more patients, but actually the algorithms that they can run on their viewer platform can act so quickly that in certain times you get a better clinical outcome for patients. So doctors love it because it allows them to do better work, save more lives. And on top of that, the payers love it as well because radiologists are so expensive. So there's natural economies that ProMedicus can capture if you have, a radiologist who costs thousands of dollars a day. And if you can triple the number of diagnoses that radiologist does in a day, then by making it faster for them, by having, a better, faster platform that does more to help them. And also, originally the selling point was just that for the competitors, you'd have to download this massive scan file and then go and make a coffee while you wait it to download to your computer. And, the way they solved that was basically allowing you to, as it were, stream through the files. Now, if you go on Netflix, you can jump to anywhere in the movie to see it. Now, it's a bit janky. And obviously for radiologists, you can't have janky streaming. It has to be a smooth ability to pick up wherever they want in the file. But that was the initial sort of selling point. Now it's moving on to bigger things with, AI algorithms being built that have limited applications right now, but more and more helping radiologists to do things faster. So that's what you need to happen to justify it at the current prices. Now that's far from guaranteed, but they're certainly heading in the right direction. But for that reason, it's not enough just to see them continuing to dominate their traditional market. What we need to do to start to justify a share price of $42 is like real uplift in revenues coming from the, I guess, algorithm side of things, which it could totally happen, which is why I'm holding on. And I still have quite a decent holding, and I call it a hold right now. But for me to buy, I want to get it a bit of a discount to that expectation. So I would need it to be lower. I don't want to say an exact buy price because, even in the last few weeks, these guys have announced a few contract re-signings and general good news. So, as a general, in the 10 years I've watched this company, it's continually getting better and becoming more dominant in its niche. So my valuation can go up day to day, but basically at the moment I'm still looking something at the low 30s before I'd probably be buying more.
Got it. Thank you, Luke. Just a buy, hold, sell for ProMedicus.
I would hold it too. I mean, I hadn't looked at it in a while, and I thought, in this market, it's probably come off, and the valuation might be interesting. It's still 100 times earnings, and it's not like talking about Xero before, where Xero is clearly under earning. They're investing heavily. These guys do 65% like EBIT margins. Like it's a genuine 100 times earnings. So I would hold it for all the reasons Claude outlined, but it's steep. Yeah.
Okay. Got it. Thank you. That's number 5 on the list. That brings us to the midway point. Our stock of the day, Diverger. It's a hold for Claude. It's a stand back and watch what unfolds for Luke. Now, Swoop, it's a hold for Luke. It's an avoid for Claude. He just doesn't get any enthusiasm for a micro telco that's rolling other companies up. Xero. Look, it's a high-quality company, both agree, but Claude says that he'd look to get it at about $60 or under. It's a hold, again, for Luke. He would look to get it a bit cheaper as well. Now, for Aerometrics, so Luke owns it. He would hold it. He is looking for concrete growth plans coming forward, and free cash flow is important to him. For Claude, he's saying it's not dominant in Australia, so with all of these global growth plans, like where's the proof in the pudding yet? So it's just a hold for him. Carbon Revolution is an avoid for both of my guests. ProMedicus is a hold for both of my guests in studio today. So nothing yet will be put to the investment committee on this program. You can watch that at ausbiz.com.au. And looking at the portfolio, Wesfarmers, Elders, ResMed were added this month, shifting around the original allocations. and we'll give you an update on the portfolio's performance to start the week. Keep your requests coming, and we'll continue to put those to the investment committee.
Grab a beer, grab a glass of wine, because this is where we just gossip.
It has been easy to get this bull market wrong.
Cheers to you.
Have a great weekend, everyone.
The Last Call is brought to you by Australian Vintage Wines. Invest in the home of Australia's premium wine brands.
Autosports Group, Smartpay, Homeco Daily Needs REIT, Energy One, and FOS Capital or FOS Capital will be covered in the next half hour or so. Let's get to the first on the list, and this is for, who's it for? Mandy. Hi, Mandy. I hope you're watching. Also, just a reminder, information only, not financial advice today. So, Autosports Group. I forgot to look at exactly what it does. Luke?
It's a car dealership, basically.
Okay.
More higher end stuff than your AP Eagers and, it's just them now. Look, I found this really interesting looking at it. I remember when it floated a couple of years ago, and it's an example now of the market looking forward and pricing in what it expects to see. So as we sit here today, it's a tick over 300 mil market cap. Cash and land actually backs a big chunk of that market cap. Trades on probably a single digit PE, like rough numbers for me, maybe 7 to 8 times. And so from today's numbers and today's valuation, it looks, more than reasonable. But again, it's that market looking forward. I think the markets assumed they over-earned through COVID with the bottlenecks on new vehicles. And that's fair enough. Gross margins averaged between 14 to 16% and spiked up to 19% last half. Now, this is a business where, gross margins shouldn't move that far unless you had some sort of external, things going on. And then the big one is obviously the consumer. As we're talking about at the start of the show, every macroeconomic indicator is screaming at us that the consumer is about to be tested, and consumer discretionary spending is about to be tested, and these guys sell new cars.
Yep. So you would avoid it? I
would avoid it. I would sit back and, if I'm there, I would probably hold it, but it'd be a very careful hold. It's not a bottom drawer stock. This is a cyclical stock, so you've got to hold it carefully and watch it. If they can keep putting in good results, I think, and dividends will be a big one. If they can keep paying good, solid dividends, you could probably keep holding it. But it'd be tough to step in and buy it today for sure.
Would you be buying Autosports Group today, Claude?
Definitely not me. But the reason for that certainty is that I've just made a decision with where I think that the macroeconomics are, that I'm not having any, just last week, any exposure to discretionary consumer stuff anymore. I just think that is like the cycle that gets hit the hardest in the kind of environment that we have now. The costs for a lot of non-discretionary things are going to go up. They're already going up. And, I just think that even though this is, I guess, mostly high-end stuff, so perhaps rich people are less impacted by this kind of thing, I just think, I'm not having any exposure for that until we see the cycle turn. Now, I just wanted to add one thing to what Luke said, which I generally agreed with, which is that even putting aside the finance of their sort of inventory, they still have about 100 million corporate debt, as I understand it. That's against about a 300 and something million market cap. So what you are doing here, just the low PE ratio, high dividend yields could easily make somebody think, oh, this is like a low risk investment or something. But because of that debt, you're going to have a fair bit of sort of leverage in terms of the value of the actual equity. So yeah, it's not that low risk. If something did go wrong, then suddenly it could look a fair bit uglier. I don't know how bad their sales will be as they come off a really good period, but certainly the most recent half was worse than the half before that. So that sort of short-term trajectory isn't looking good. At the end of the day, you could definitely just hold this through the cycle, but you just want to have an appropriately small position because it could get really painful. For me, it's not something that I'm interested in, but Just as long as you realize that it's kind of risky.
Now,
just quick, sorry. The debt is backed by the land.
Okay.
But of course, there's question marks over what land values will do, and we've got a REIT coming up, which will dig into that.
Okay, well, let's get there then. First, Antares Technology, or Smartpay, I should say. Smartpay is coming up next on my list, not on my notes, but that's okay. Given your comments about the consumer, would that also mean that you wouldn't be interested in sort of a payment platform as well?
Yeah, so that's right. That's probably not the driving reason why I don't like Smartpay. There's a bit going on here, and a few ways to explain my reticence. But perhaps the easiest starting point is just to sort of say that, this is a business that in the last year made about 2.7 million loss before tax. Profit before tax, I beg your pardon. But that puts it on a PE ratio of, I think, over 50 at the moment, right? So if you're actually rating it on a PE ratio, like, there's a lot of good quality companies that are available for lower than PE 50. So the market's kind of trying to say, with that pricing, that this is actually quite a high quality business. And then sitting with this idea that it's a high quality business, you have some huge, because these guys are basically in the business of getting terminals out in retailers, and their New Zealand business they call mature, and that's not really growing. So most of their growth is in Australia. Well, in Australia, they face competition. Like, forget the legacy big banks for a minute, but you've got Tyro, you've got this company called Lightspeed Point of Sale, which is interesting and caught my eye because my pub used to use Smartpay because they thought Smartpay was the cheapest, and then they changed to Lightspeed Point of Sale. And I asked them, why did you change to Lightspeed? And they're like, oh, it was a bit cheaper.
Yeah, okay.
And I've spoken to people about this, and they think that the only cheapness is the cost that the merchant pays, but they think the selling point for Smartpay is that you put the fee onto the buyer, right? So when, at some businesses, when you try and pay by card, they have a little sign that says, you have to pay a surcharge. Okay, fine. But, that's still a thing that affects their business just because they don't have to pay it themselves, and because that affects their customers. So I still think that there's competition in these fees, and just because you're putting it onto the customer doesn't mean that it's like sort of magically doesn't count.
So it's an avoid?
I think that it's an avoid because the bull narrative that has been told, which is sort of what I just summarized then, being told far and wide, everyone believes it, but I'm not sure how true it is.
Do you believe it, Luke?
Not completely. I'm probably not as bearish as Claude. I think I agree with his take on the competitive nature of the industry, and I've stayed out of this stock because of that. I struggle to see how it all fits in. You've got Tyro as an obvious competitor to them, but then just all these other players in that payment space. What's Apple doing there? Who knows?
Square. That's what I was thinking.
Yeah, exactly. So that's what's kept me away. The one thing I think Smartpay does well, and where I've sort of view Smartpay compared to them, this is a marketing business more than a payments business, and they've had success doing it. It's the way they market, as Claude puts it. They have their smart charge system, and it's the way they market their smart charges. Merchants, effectively don't pay for the cost of the terminal, gets put onto the customers. There's really no edge there, as Claude points out. It's just the way it's marketed to these customers. Look, I'll give them the benefit of the doubt though. It is genuinely profitable, like net profit and free cash flow. If you're sitting there and you're looking at Tyro, which probably trades on 5-10 times a market cap, I would much prefer something like a Smartpay. But I generally agree with Claude's point that I think that competitive nature of the industry, it's hard for me just to look 5-10 years out and say, where does Smartpay actually fit? It's there today and doing well, but it just moves so fast, that whole payment space. Okay. So I'd stay away, yeah.
All right. Now, the thoughts on the consumer that we've been expressing through this half hour, 40 minutes or so. Shane is asking about the Homeco Daily Needs REIT. It's recently had a merger. So what do you think about that REIT when you consider that it's related to consumer spending particularly?
Well, I mean, my major point is, like, I'd struggle to touch any REIT right now. I really would. And I think some of them, have really got their heads in the sand with what I'm seeing, updating the valuations of their portfolios. So I flicked open these guys' latest portfolio valuation. They've reduced their capitalisation rates from 5.56 to 5.34 in the last 6 months. That's in a period where treasury yields have gone from, sub 50 basis points to 4, like 4%. I just don't understand how anyone is signing off that these guys could justify lowering their capitalisation rates. Like, you can get the Aussie 10-year for pretty much just over 100 basis points less than this REIT. put that to the side. Operationally, it looks okay. 99% occupancy, foot traffic's holding up. I go back to your point though, Nadine. This is a well and truly discretionary, consumer discretionary exposed REIT, and so we've discussed it with a few stocks today. The market is screaming at us that these consumers are about to be hit hard, and the hip pockets are about to tighten up. So I'd be probably out of that one if I'm there, to be honest. Whether you look at other REITs, my only advice would be look at what they're doing with their portfolio valuations. If you see some that are being very conservative, I'd be much more interested in them. I'm just seeing a lot of them, lowering their cap rates in this environment.
Okay, so that is a sort of a sector avoid, really. When it comes to the REIT in particular, Homeco Daily Needs REIT, HDN, have a tough time saying that one for some reason. Claude, what do you think? Buy, hold, or sell?
For me, definitely a sell. I had a feeling that Luke might cover some of the points that I wanted to make on this, but for anyone at home that didn't get that sort of perfectly in their head, basically what Luke's saying is that the valuations that they're saying that their businesses are worth are probably too high, because basically when your safe money options, which is like government bonds or whatever, is going up and offering a higher interest rate, then the real estate, which is kind of can be compared to that, should offer a higher yield, right? Because if you've like got a shopping center that's got retail stores in it, you're taking more risk than that you won't get paid than if you're lending money to the Australian government. So basically the valuations should go down, not up, is essentially the point that at least I'm making, and I'm sure Luke was making as well. So yeah, look, this looks like head in the sand stuff to me. I think that you've got to just also look at the actual dividend yield of these REITs, and they're just crazily low for what you're getting these days. So yeah, I wouldn't touch it. I think this is probably one of the worst ones because it does have potential to actually, it's got really good times with its tenants right now. Retail's done really well in the last couple of years. Despite all of the interruptions, there's been JobKeeper and JobSeeker, and we've had this booming consumer. That's why we've got inflation. It's been good for retail. Like, if and when that changes, which I certainly think it will, then this is definitely not where you want to be. So yeah, no, this is probably one of my least favorite safe stocks. I don't think it's safe at all.
Can I just make one more point? I meant to say this, sorry. Claude, I might have been a bit too high level. He's explained it well. So what the market does is that if the market says we think your valuation's too high, it just puts them on a discount to their NTA. So one thing I wouldn't do in this environment, if you're looking across the REIT sector, is analyse any of them on a discount to NTA, because that's the market saying to these guys, we think your NTA is wrong. We're going to price you, 10, 15, 20% discount. So don't sit there expecting, I buy XYZ REIT on a 20% discount to NTA, that closes over time, because that's the market telling you it may well come the other way.
Right, okay, so let's get to stock on the list for you specifically, Claude. Energy One. Stephen writes in, the Australian energy market operator suspended the spot market in the national energy market. So how will this affect Energy One's operations? Could it potentially permanently change the fundamentals, or will the regulation affect the company? So Claude, give us your key points, and again, whether this would be a reason to maybe lighten up or sell.
Okay, so I definitely am not lighting it up. Like, I actually just slightly topped up my holding the other day. Or even like this week. So this is actually, I think you asked me what I've been doing this week. Well, this is one of the companies I had a nibble at. So definitely not being spooked out by this. I actually kind of already knew the answer to this question. Unfortunately, the share price is so illiquid that the 1 year share price doesn't tell us a lot there. But and also the share price is now $4.50, importantly, not $6.40.
We'll take that down.
Yeah, not sure why that's there. Just a bit misleading, but so it's actually $4.50 right now. If you go and put it in, or let me just check. $4.69 as we speak, but $4.50 earlier the week. That was the price that I had a nibble at, $4.51. So basically, I did actually clarify with the CEO, just even though I'd already talked to him about this. Look, the reality is this AMO stuff, it can cause retailers to go bankrupt. Now, some retailers are customers of Energy One. And what the main reason that they ever lose business is because the customer goes bankrupt. So the questioner here is absolutely on point. It's the right thing to be asking. However, the CEO just wanted to like let us know that they have a diversified customer base, and they're not exposed solely to retailers. Like, they're also exposed to the generators, right? They are part of the wholesale market, not just one side of the wholesale market. So it's not like they're exclusively exposed to the guys that are getting hit hard. Now, already at the EGM, they said, basically, more stuff has happened since the EGM, but they basically said they don't have any material exposure to small retailers currently experiencing financial difficulties, nor do they believe that they will. That's what they said publicly. So I don't think it is a big worry. Certainly, I think that this is one of the most interesting businesses because this one, it looks way more like a company that could actually do a life-changing return for me than some of these big quality companies where I've already been on the journey. Yeah, they're my big holdings now, but a lot of we're talking about ProMedicus on a massive PE. Well, these guys are small, they're little known, and they've got this tailwind in the sense that they are expecting that the increasing transition to renewable energy will drive demand for their software, but also their software plus service offering. And that's where they're expecting the growth to come from, or a lot of the growth to come from. Because say you got a new wind farm, you don't necessarily want to build like a 24/7 wholesale energy trading desk. Well, these guys have that. They offer that as a service. So it's not just the software, it's also the people running these risk strategies. Now, the risk here is, of course, that you're a bit more of a people business there. So it's not quite as good as just a pure software as a service offering.
Okay, so Energy One, you don't think it's going to be affected by this energy market real crisis that's happening here. Bottom line, though, to answer Stephen's question, would you be buying it at these levels, or what are you doing?
Yeah, so I did have a nibble recently at a little bit lower than the current share price, actually. But I wanted to make one last point, which is that because they've just done this acquisition, I think that the FY 2022 results, which are going to come out in August, may disappoint some people because I think that the profit will be lower due to the acquisition tumult. So, and they've only given us EBITDA and revenue guidance. So there may be some disappointment there. We may see some more weakness there. I'm actually hoping we do see weakness there and some people push the share price down more. And then I would probably try to be on the other side of that trade if the underlying results are good, if it's just that the statutory profit is disappointing.
Okay, got it. Thank you. Luke, I'm going to be strict. Buy, hold, sell. You can give me one comment.
Yeah, look, I'll try and be positive because we've been so negative today. I think it's a buy as well. It's a liquid, so be cautious with it. Claude and I have covered this a few times. I mean, people need a bit more info. Google, search for it on the website. Yeah. You'll see us talk about it a few times. My only comment, I just want to back up what Claude said to Stephen. I think the question he's asked is a really good one. That's how people should think about companies in their portfolios. What's going on in the world? How does this affect the businesses I own? I think that's fantastic. So, yeah, I think let's be positive and say buy.
It's a double buy. All right, FOS Capital for Patrick. Luke, what's going on in the world? It's essentially a lighting provider here in Australia and New Zealand.
A lighting retailer.
Are people going to be changing their lights?
These guys are more industrial. Yeah, they're more industrial.
So that speaks to the construction demand.
That's right, yeah. So these guys need to win contracts. Yeah, it's not the world's best business, but I've got it on my extended watch list. It's tiny, 10 mil market cap. They put some guidance out there, which I have no doubt they'll miss. But it'll likely still be break-even / slightly profitable, moving in the right direction, probably just slower than,
It doesn't sound like it sets the house on fire.
No, it doesn't set the house on fire. That's why I'm just sitting back and watching it. For me, look, if you're there, hold it. It's in a liquid stock. I think if you've got a position, it hasn't disappointed you, but, like a lot of micro caps, they're small. It can sometimes just take a while to, really get things moving. So watch list for me. But yeah, they've just got to keep winning contracts, which I think they've announced 2 or 3 in the last month or 2. So that's what you want to see.
Keep going, FOS Capital. Okay, what do you think, Claude? Buy, hold, or sell?
I probably do have to just call this one a sell now. I actually previously owned the business, so probably the last time I've spoken about it, I was more positive. Look, they haven't done anything wrong, as far as I'm concerned. They remain an interesting microcap, with I think honest, competent management from what I've seen so far. The current settings are really unfavorable for them. They're what I would say is like a subscale distributor. So the thesis was that they get onto the market, they roll up some other businesses, they get a bit more scale, and then you get economies of scale helping them out. Well, the current situation with supply chain difficulties, inflation, and all that kind of stuff, and now potentially recession, is all probably goes against them. So I just sort of see potential for short-term pain. Notwithstanding, I don't think it's the business's fault. I just think that it's sort of unlucky timing, and it's just not it had a very slim profit in the last half, and I wouldn't be surprised to see that go to a loss now.
Great. All right, guys, we did hit. Not bad time either at the end of it all. Let me just run you through what we've learned. So Autosports Group, it's an avoid for both of my guests. And Smartpay, it's an avoid for both of my guests as well. Luke says it's pretty much a marketing business. Homeco Daily Needs REIT, it's a sell. So if you have it, get rid of it for both of my guests. Energy One, it's a double buy. It's a liquid though, keep that in mind. That's from Luke. But to answer your question, Stephen, the consensus and what Claude believes is that it will not be impacted by the National Energy Market Operator suspending the spot market in the National Energy Market. And for FOS Capital or FOS Capital, it's a sell. For Claude, you just heard why, but it's a hold. It's a wide range, I guess, a watch list down at the bottom of the watch list for Luke from Merewether Capital. Hey, Luke, nice to see you. Thanks for coming.
Yes,
Thanks
I'll be
for
back
coming
for the last
to the
call.
studio. Oh, awesome.
Yeah,
Look
hanging
forward to
around.
that. Anyways, we'll talk off there. Claude, thanks for coming, even if it's remote.
Thank you
We
for
look
having
forward
me.
to seeing you in the studio. It's always great to get your thoughts, guys. Really great conversation, and particularly for all those small and micro cap investors, which of course we love. The small caps is coming up next. Stay with us.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.